Hi, friends. This is Brant Spessart, and thank you for joining me for our 2025 Equity Market Update and Year-End Proactive Tax Planning. We share this information with our clients so they can be better stewards because we truly believe that knowledge is power. We want to be wise when we make financial decisions. That's why here at Steward Strategies, we try to share information that is both relevant and meaningful. An educated client is our best client. But here's what we have to remember when it comes to financial planning. There's a lot more to financial planning than just investments. Retirement planning, investment planning, tax planning, protection planning, estate planning, and generosity are all key components of a financial plan. So today we're going to touch on an economic update, but we're also going to talk about some proactive tax planning for you between now and the end of the year. 2025 has definitely been a volatile year. We started the year off with a change in administration, then there was an introduction to tariffs, implementation of tariffs. We have still seen headlines regarding Ukraine, Gaza, Middle East, as well as interest rates and inflation. These are all concerns and headlines that have caused a lot of volatility so far this year. But inflation is one of those areas that has had consistent concern for spenders. The cost of goods and services continue to go up. However, the rate at which things are going up has slowed down significantly. Interest rates have adjusted some this year. The Fed has met a couple times now, and actually in September and October, the Fed decided to cut interest rates. This is the first time it happened so far this year. So many savers are starting to see lower interest rates at the banks and with safe investments like bonds, CDs, and money market. But that's good news for borrowers who are maybe buying their first home or making significant purchases. Interest rates are lower right now. Now we're in fourth quarter. And what does that mean for the market? If we think about things from just a short-term perspective, we look at each quarter going back over the past 75 years, fourth quarter tends to be one of the better performing quarters of the year. You can see right here, possibility of posting a quarterly gain is about 80% for fourth quarter. Now, this does vary year by year. As of the time of this recording, we're hopefully wrapping up a government shutdown right now, which is affecting certain industries such as the travel industry. But, historically speaking, Q4 tends to be one of the best performing quarters of the year. But we know that successful investors don't focus on the day, the week, the month, or the quarter. They focus on the long term. And if we look at the past 4 decades, if we look at the past 40 years, even 30 years, 20 years, 10 years, long-term focus has helped investors gain tremendous results. The market is up daily, weekly, monthly, quarterly, even annually. But the other thing that we know is true for long-term investors that have held on for a portfolio that's just invested in a basic index like the S&P 500, wealth has been created. But here's the thing we have to keep in mind with investments. Control what you can control. It's good to revisit and focus on your risk tolerance, but it's also good to keep in perception your time horizon. But then it's not finance, it's personal finance, and we know that behavior can significantly affect how we control our finances. So we have to be careful not to let fear or greed control us as investors. And then our job at Steward Wealth Strategies is to also help you focus on your goals and objectives, help you focus on what helps you generate the results you need for success with your financial plan. Warren Buffett said it, we don't have to be smarter than the rest, we have to be more disciplined than the rest. Now this year, in addition to investment changes and volatility, we've also seen the implementation or the introduction of the One Big Beautiful Bill. So here's some things that have stayed the same with the passing of the OBBBA. Long-term capital gains rates are staying the same. They are still 0, 15, and 20%. The brackets are going to adjust a little bit, but we're still going to have favorable capital gains, long-term capital gains, and qualified dividend rates. The Tax Cut and Jobs Act, we were concerned as to whether, hey, will we go back to tax brackets that we saw 10 plus years ago? And right now, the Tax Cut and Jobs Act, it's being stated that it's being made permanent, but that's only permanent until future change. But the 7 tax brackets that we're enjoying right now will continue into 2026. We are still seeing the higher standard deductions. So a lot of folks stopped itemizing a few years ago with the Tax Cut and Jobs Act because of the higher standard deduction. Well, those higher standard deductions will stay for now. And there's also an additional standard deduction for retirees age 65 and over. It is temporary and it does phase out with higher income, but it can be as high as $12,000 in addition to your standard deduction for those 65 and over. The state and local tax, which is also known as SALT deduction, the cap has been raised. For the past few years, the SALT limit has been up to $10,000. Now, the deduction for those that itemize can be up to $40,000. This is very significant right here for folks that may or may not itemize. If you have a lot of state and local taxes, plus maybe some healthcare expenses and charitable giving, you may find yourself itemizing for 2025 and beyond. The new tax bill also expands the child tax credit. It makes permanent the Tax Cut and Jobs Act mortgage interest modification. There is a potential for new car interest loan deduction. Qualified business income deduction has been made permanent. There are tax deductions for tips and overtime pay. And next year, we will see the introduction of the Trump account. Now, here's what we have to remember. There is a difference between tax planning and tax preparation. Tax preparation is filing our taxes for the prior year. Tax planning is where we think ahead. We think about the future. And one of our main goals when it comes to tax planning is how can we reduce taxes? So one way is to make sure you don't overlook or forget about your retirement plan contributions. Retirement plan contributions have to be adjusted before the year end. There are significant ways to contribute towards retirement through a 401k, or if you work for a smaller business, they have maybe a simple IRA, or if you're self-employed and you have a SEP IRA. But also remember, many workers can also contribute potentially to a Roth or traditional IRA as well. And if you're 50 and older, there are catch-up provisions, and sometimes it's even more enhanced for a 401k. Now, retirement plan contributions through work generally need to be made before year end. So if you're watching this and you want to make sure you contribute enough between now and the end of the year, reach out to your HR or payroll department to see if they can help you make adjustments. But IRA and Roth contributions you have up until April 15th or your tax filing deadline, whichever is sooner. One thing to keep in mind with the Roth is a Roth conversion. Roth conversion is something you need to do between now and the end of the year if you wanted to count towards 2025. Here at Steward Wealth Strategies, we recommend clients inform us if they want to do a Roth conversion by Thanksgiving. There's processing time, there's generally paperwork involved, and with holiday schedules and holiday hours, as far as the stock market's concerned, you don't want to wait till the last minute. But Roth conversions over the long term can possibly help reduce your overall taxable income. Roth grows tax-free, so it has tax-free compounding. Roth IRAs are not subject to required minimum distributions like traditional IRAs are. And when inherited, the Roth can be a great wealth transfer tool because it's tax-free withdrawals for beneficiaries as well. But if you're thinking about this from a legacy or wealth transfer perspective, you should take into consideration family tax bracket management. If my wife and I are retired, have a lower income, and we're at a lower tax bracket than our adult working children, it may make sense for us to do a Roth conversion so that our heirs inherit tax-free. But if we're working, have high incomes, and our children have lower income, are in a lower income tax bracket, then it may not make sense to convert. So take into consideration the inheritor as well as the converter when it comes to Roth conversions from a tax planning perspective for wealth transfer. But I love the Roth conversion personally. I love the idea of paying tax now, having the account grow tax-free, potentially reducing required minimum distributions down the road. That could possibly help us from an income tax perspective. It could possibly help us from a Medicare premium perspective. There's a lot of pros and cons with Roth conversions, and you have to make sure you're making a decision that is in you and your family's best interest. Please consult your tax advisors. Reach out to your wealth manager here at Steward Wealth Strategies, but also reach out to your tax preparer so that they can help run an analysis for you. For 2025, the annual gift is $19,000. That means a donor or a donee can give, or a donor can give up to $19,000 to any individual they'd like and not have to worry about claiming it. Now that is per donor, so a husband and wife can give up to $38,000 per donee. So that can be to as many people as you want. You just can't exceed that limit. Now, if you're helping make medical payments or educational payments, those contributions or payments made directly to the institution do not count as a gift for gift tax purposes. Another thing to keep in mind between now and the end of the year has to do with charitable giving. Fourth quarter is where the majority of nonprofit organizations receive their funding. Most givers give more towards the end of the year. And a very popular type of gift for our retired clients that have retirement savings is a qualified charitable distribution. This is where you're actually able to gift money from your pre-tax traditional IRA to a qualified charitable organization. So think about it. If I'm retired and I have an IRA and possibly I give on a regular basis to my church, I could consider gifting directly from my pre-tax traditional IRA. Now, here's a requirement. I have to be at least 70 and a half years old. But the good news is if I'm 73 or older and I'm taking required minimum distributions, a QCD can actually count towards that RMD. Now, there is a limit on how much you're able to gift per year from a traditional IRA. The qualified charitable distribution limit is $108,000 per person. And a QCD allows you to, again, take money that's in an IRA, a pre-tax account, give it directly to a charitable organization, but there are certain rules you have to follow. So if this is of interest to you, please reach out to your wealth manager here at Steward Wealth Strategies and let them know that you would like to have a conversation or discuss possibly doing a QCD. Now, if you're trying to do this for 2025, this has to be complete before the end of the year, and the charitable organization has to cash the check as well. So just like with a Roth conversion, we highly recommend that you make a decision and we start the QCD process by Thanksgiving. So here at Steward Wealth Strategies, we're here to help you with your financial planning. Not just investments, but retirement strategies, tax strategies, estate strategies, generosity strategies. We are here for you. We know times can be volatile. We've talked with many of you so far this year when it comes to investments. But this time of year is a really busy time of year because a lot of folks are thinking about year-end tax planning, year-end charitable giving strategies. What do I need to do for 2025? So please reach out to your team member or reach out to our team here at Steward Wealth Strategies. Whether it's your specific advisor or not, our team is here to take care of you. You are a client of Steward Wealth Strategies, and we care about you, and we appreciate the trust that you have with us. And it's an honor to serve you, and we want to help you be good, wise stewards. Now, our best clients come from our best clients. We would love for you to consider being a Steward Wealth Strategies ambassador. If you have a friend or a family member that you think would benefit from a second opinion or a conversation with a member of our wealth management team, please, if they meet with one of our team members and have a conversation, that helps you qualify as a SWS ambassador. Or if you're part of a group that you think would like to have a financial planner come in and speak, maybe you're leading Financial Peace University at your church, or maybe you're part of a retired group that likes having education, that has educational workshops. We would love the opportunity to come in and share. That would help you qualify as a Steward Wealth Strategies ambassador as well. Please follow us on social media: Facebook, Instagram, YouTube, LinkedIn. Please stay connected with us. We love it when people comment and like what's going on here at Steward Wealth Strategies. We have a lot of very educational information that we share, but also uplifting information as well. As the founder and president of Steward Wealth Strategies, I want to just say thank you for your trust. It is an honor to serve our clients. Many of you have seen us grow because we've seen you grow as well. And just know, here at Steward Wealth Strategies, we don't take that trust for granted. We're grateful for you and those relationships. I hope you and your family have a wonderful Thanksgiving and a super blessed Christmas. Thank you very much. God bless you.